Hi, DataTrek co-founder Jessica Rabe here, and for today's video, I'm going to discuss global venture capital funding and its relationship to public equity markets. We often update clients on the VC industry in the disruption section of our daily market newsletter because venture capitalists find, develop, and fund innovative and disruptive businesses. The best of these often go public and can mature into large public companies. This helps drive long-term stock returns, so it is our long-held belief that the more VC funding, the better. It's essentially a free lunch for public equity investors. We have 3 points on this topic. First, public and private markets may take similar philosophical approaches when investing in disruptive innovation, but over the last year or so, they've gone their own ways in terms of investor confidence. Here's a chart that shows global monthly venture funding amounts from Crunchbase and the month-end levels on the NASDAQ from January 2021 through the latest available data in January 2024. You can see that global venture funding rose along with the NASDAQ through most of 2021 and peaked at $71 billion in November 2021, which was the same month as the NASDAQ's all-time high. Venture funding declined sharply thereafter, along with the NASDAQ, and bottomed at $18 billion in February 2023, shortly after the comp troughed in December of 2022. Although the NASDAQ rallied last year and continues to advance this year, venture funding has remained depressed. There are two reasons for this. The first, ongoing headwinds like high rates, macroeconomic and geopolitical uncertainty, and a largely closed IPO window have definitely hurt VC investor confidence. Second, a lot of the capital they invested at the peak in 2021 went to companies that are now struggling. VCs are likely conserving capital, knowing that they will have to provide incremental funding to some, but not all, of these businesses. The upshot to this chart is that private and public markets have gone their separate ways, and it's going to take some time before venture capitalists get their courage back. Lower interest rates would help, as would a better IPO environment. Neither of these things will happen overnight, so we expect VC funding to only slowly recover over the balance of this year. Moving on to our second point, let's look at VC trends over the last decade. Global venture funding actually fell to its lowest level in 5 years in 2023, wiping out all of its pandemic-era growth. Here's a Crunchbase chart that shows global venture dollar volume by year along with our annotations in red and blue. Before the pandemic, global venture funding totaled $300 billion in 2019. It grew a further 13% to $340 billion in 2020, despite the pandemic crisis. That's because VCs looked for businesses that could leverage both new social trends and the trillions of dollars pumped into the U.S. economy from fiscal and monetary policy stimulus. They saw this as a once-in-a-generation opportunity to quickly build businesses to capitalize on American consumers who were temporarily flush with cash. Global funding then doubled to an all-time high of $694 billion in 2021. As we mentioned earlier, it peaked at around $71 billion in November 2021, the same month as the NASDAQ Composite's all-time high. Global VC funding then declined by 33% to $462 billion in 2022 amid rapidly rising interest rates and a challenging economic and geopolitical environment. Interestingly, that 33% decline is actually the same percent decline as the NASDAQ comp in 2022. Even though the NASDAQ rebounded by 43% last year, global VC funding dropped 38% to $285 billion. So the upshot here is that the last 2 years popped the global VC bubble sparked by the speculative tech craze during the pandemic, and herein lies an important lesson for both private and public markets. We have a general rule of thumb that whenever an asset doubles in a year, it marks a bubble and usually reverts to the mean thereafter. Think the NASDAQ comp in 2000 or crude oil prices in 2008. Global VC funding doubled in 2021, something it had never done before back to 2014. So to put this in perspective, its 3 best growth years behind 2021 pale in comparison. Global funding was up 40% in 2015, 43% in 2018, and 27% in 2017. Even though funding rose by $394 billion from 2019 to its peak in 2021, it fell by more than that, $409 billion from the peak in 2021 through last year, down a net $15 billion or lower than immediate pre-pandemic levels in 2018 and 2019. Overall, global VC funding in 2023 was down 5 to 16% versus 2018 and 2019. So, the bottom line here is that VCs have pulled back on funding startups to levels more in line with pre pandemic run rates, at least in part due to the ongoing dearth of exit opportunities amid a disappointing IPO market. As a result, VCs are being much more selective about the companies and themes they're backing. We also think that FTC and DOJ's more aggressive antitrust stance is playing a role because VCs can't be sure that their portfolio companies can or will be acquired by large public companies. This further crimps their desire to make incremental investments. The third and last point for today's discussion is that venture capitalists and public equity market investors have identified similar pockets of opportunity over the last year. Just like enthusiasm about generative AI has driven U.S. equity markets higher, it's also kept VC funding somewhat afloat as other previously hot sectors struggle. For example, global funding to AI startups increased the most of any sector last year, up 9% year over year to nearly $50 billion, according to Crunchbase. Put another way, AI funding accounted for almost a fifth of aggregate global funding in 2023. In fact, 3 Gen AI companies alone raised $18 billion and were the largest fundings in 2023. They made up a little over a third of overall AI funding. By contrast, some of the largest sectors for VC funding in 2021, like financial services, e-commerce and shopping, and media and entertainment, were down over 50% year over year in 2023. Notably, Web3, which had a banner 2021 and early 2022, fell 73% year over year in 2023, down to $7.6 billion from $28 billion, according to Crunchbase once again. So, as much as AI attracted capital last year, leading sectors at the height of the 2021 VC funding cycle, such as financial services and e-commerce, have seen VCs pull back their investments significantly. Clearly, VCs overvalued many startups in 2021, many of which had to quickly switch to conserving cash and raising down rounds, if possible, in the following 2 years. In fact, most venture-backed startups that went public in 2021 are still trading below their IPO price. The same goes for a couple of venture-backed startups that tested the waters with IPOs in the back half of 2023, such as Klaviyo and Instacart. Given this shaky backdrop, Q4 marked the low for global venture funding last year, and therefore had poor momentum heading into this year. Global funding has started this year on a tepid note as well, at only $22 billion, just below the monthly average for 2023, again according to Crunchbase. So to wrap up, global VC funding has yet to find a bottom as this market still corrects from its inflated pandemic-era valuations. As much as the NASDAQ is very close to an all-time high, its all-time high in November 2021, the ARK Innovation ETF, which is our proxy for public speculative tech names, is still down 67% from its record high in February 2021. Similar to ARK, global monthly VC funding is down 69% since its record that year. Until there's more clarity on the macro front and a successful batch of venture-backed IPOs, VC funding will likely struggle to reaccelerate meaningfully. We believe that the sooner it finds its footing, the better. Even though we associate VCs with leading-edge technologies, VCs respond to macroeconomic and public equity market conditions rather than setting them. Future long-term returns for U.S. stocks rely on new companies that are often initially funded by venture capital, develop under their guidance, and eventually go public. A look at the last decade's winners, Alphabet and Meta, for example, tell that story. We have no doubt that the next decade or two will be the same. Whatever company is believed as market leadership in 2035 is likely getting funded by VC now. Thank you very much for taking the time to watch our video. Please hit the like and subscribe button to our YouTube channel if you enjoyed it. And be sure to check out our website, datatrekresearch.com, for a free trial to our daily reports on markets, data, and disruption. There's no credit card or personal information required. You just drop your email in. Thanks again for watching, and we hope you have a great day.